Will they or won't they? Will the Reserve Bank cut the official cash rate again? For the last year, we've been pretty sure that there would be a cut, and the only question was how big. But this time around, no one's exactly sure. What's really going on with inflation? How is the economy going? And will the new Reserve Bank governor and his colleagues at the Monetary Policy Committee actually cut again? Financial markets aren't sure about it. And this week on When the Facts Change, Sabrina Delgado from Kiwibank talks through that uncertainty and why she thinks, and Kiwibank thinks, there needs to be no mucking around, interest rates need to be cut. But there is uncertainty this week on When the Facts Change. Well, welcome back to Sabrina Delgado from Kiwibank, to the spin-off studio for another episode, a romp around the economy and global economy to look at what's happening with interest rates, house prices, the employment market, what's happening with the US dollar, New Zealand dollar. It's going to be a cracking romp. Sabrina, firstly, next week, we have this decision from the Reserve Bank about the official cash rate. It's currently at 3.25%. And the mood of the public is very much, well, it's falling and it'll go much further. But what are we likely to see next week? What's the tone of the debate like?
Wow, thanks for having me back on, and straight with the big questions, aren't we, today? Well, I would say that this upcoming decision is probably the most, contentious one we've had in a while. You know, we've had 225 basis points of easing, and a lot of that, once they started cutting, a lot of those cuts were expected. What we're going into, though, is that following the May meeting that we had from the Reserve Bank, we had a bit of a hawkish tone from the committee. If you looked at the statement, that was pretty dovish in itself. But then we got to a press conference, there was a few hawkish remarks, and then we also heard about that 5-1 dissenting vote. So
that was really unusual, wasn't it? Because
it was.
Previously we've heard this phrase consensus, and we haven't actually seen too many of these divided votes. But obviously someone wanted everyone to know they voted against a cut, which was unusual and sort of, to be frank, quite welcome, given that every other central bank does publish who votes, or at least the split in the votes.
Yeah, so you can imagine how the public has sort of taken that and gone, oh, what does this mean for this next meeting? It's thrown a bit of uncertainty around the timing of a next cut, whether we get one next week. I think we're of the view that more rate cuts are still needed. Our head forecast for interest rates is that we get to a 2.5% cash rate.
So three more cuts, 25 basis points each.
And if it was up to us, I think if we were sitting there, we kind of have this no mucking around phrase that we like to use. We've recently updated our forecast for the Kiwi economy. We've had to revise down our growth forecasts. Inflation, yes, we're going for a bit of a near-term spike at the moment, but in the medium term, that actually has potential to undershoot that 2% sweet spot. So given that policy is set for that medium term, if it was up to us, we wouldn't be mucking around. We'd cut and deliver the relief that we need now, and then, be in a place to hike when you need it, right? So I think it's always an interesting thing of what we think the Reserve Bank should do and what they actually do. I think there is this growing consensus that, they might pause next week, come back in August when they have a bit more data. So it'll be an interesting meeting.
Yeah, so this idea of let's get there to 2.5% quickly, why do you think the economy needs that extra impetus from 75 basis points of cuts?
Well, there's quite a few factors at the moment. The main one I'd say is there's a lot of downside risk to the economy. But also, first and foremost, is that I don't think we're in a place where the economy is really, really growing with any real momentum. We have seen a couple of strong quarters of growth over the summer months. But if you sort of look at the more high-frequency data now for the current quarter that we're in and upcoming quarters, we are actually expecting a bit of a slowdown in this pace of recovery. And then on top of that, you've got the global picture, deteriorating. There's a lot of words you could use right now to describe how the global outlook has changed: deterioration, murky, confusing, uncertain. All of these are quite bad words, and they weigh quite heavily on global growth. no matter where you look, you can look at the IMF, the OECD, the World Bank, global growth forecasts have just been slashed everywhere thanks to this tariff and trade policy that's still up in the air, definitely calmed down since, April Liberation Day, but still up in the air. And then you've got other geopolitical issues. All of that, it's not good for global growth and not good for us as a small open economy. So I will say, we're still in a very vulnerable position. The areas where we have seen growth in the economy so far has been really kind of divided. We've had a lot of a good performing external sector, so things like your agricultural, even your tourism, but those interest sensitive areas, they're still pretty weak. That's why we think we need more rate relief there. And again, it also comes back down to inflation, that in the medium term, we do see inflation sort of undershooting that mid 2% sweet spot.
Yeah, we've had some, as you say, high-frequency data through, in particular the surveys of business decision-makers. We've had the New Zealand Institute of Economic Research's quarterly survey of business opinion this week, as well as the ANZ Business Outlook survey, and then also, in the last couple of weeks, some quite negative survey results from the Business New Zealand, BNZ, PSI and PMI surveys of purchasing managers, which seem to show that businesses are quite downbeat about what's just happened. They still seem to be more confident about the future, but could you tell us a bit more about what we've found out from these three sets of business opinion surveys about what's happening with, firstly, inflation, because there's an interesting little factoid which I'd miss, but that really tells a story about the pricing pressures in the economy.
Yeah, so what we saw from the QSBO was that firms for the coming quarter ahead are actually expecting, a net 2% of firms are expecting to reduce prices in the coming quarter ahead, which outside of COVID, removing that blip, we haven't actually seen that in the survey since 2009. So that really tells you that the weakness in the economy is still so strong that price pressures are being really restrained. And I think that's a really important story here because we are at the moment temporarily going through this sort of spike in inflation. Food prices are up, energy costs. Then there's also the talks about how tariffs will be inflationary, but that's all in the near term. And if you look out further along, that's actually where you're going to start getting some lower price pressures there. So that's really good news on the inflation front. In terms of how businesses are feeling, you really nailed it, hit the nail on the head there. It's really fascinating. Businesses are, even though the current environment and reality is still biting, they're optimistic about the future, and they have been. For the past 5 quarters, I think we've seen an improvement in how firms are looking to the quarter ahead, even though if you actually look at the experienced activity in the current quarter, hasn't actually changed. We're still in these contractionary low levels. But, it is kind of as you'd expect. You're crawling out of this recession, right? You've gone through the worst and you can only hope for the best. So that's really good. But it's the right now that's still demanding more rate relief. I guess some other good news in that survey was that we finally saw investment intentions lift into the positive for, I think, the first time in 13 quarters, if you exclude one temporary blip after the election. And that's kind of what we've been waiting for. I'm sure the investment boost scheme might have helped a little bit there. I think other firms are definitely still holding off for a more sustained, more conviction in a sustained recovery. But overall, I think it's optimism for the future, but right now it still hurts, right?
Yeah. And that's being translated too through to the housing market. It's always a bit quiet in the middle of winter, but we haven't really seen the housing market catch fire or even be a little bit warm after those rate cuts of the last year or so. What's going on in the housing market? Because for so many homeowners or aspiring homeowners, house prices, sales activity is often a sort of a generator within the economy that makes us more confident to spend or gives us some cash to spend or makes us feel wealthier. What's happening in the housing market?
Yeah, so with the housing market, I think lots of forecasters have been surprised continuously on the downside. We've, in the past been quite optimistic about saying, this year we might get 5 to 7% house price gains. I think we've said that for the past year, maybe 2 years, and we've been proven wrong. We thought we might see it when we got that big net migration boom over 2023. Then we saw the migrants were pretty young, not really adding to that housing demand, but the rental supply, yes. Then we thought, okay, rate cuts are here. That's going to start bolstering house prices. It hasn't yet. Part of that, I think, is we're seeing a record high number of housing stock on the market, a bit of a surge in new listings, also happening at a time when net migration, though still positive, has significantly cooled. And also the labour market is just still deteriorating, right? So that's also weighing on really prices in the near term. So we have revised down our forecast for house price growth this year. I think we might get 3%. And then further out, say 2026, as that recovery, hopefully is more embedded, we could see those house price gains of about 5 to 7%.
Just thinking back to a year ago when the official cash rate was significantly higher, 225 basis points higher, and things felt pretty tough. And if you'd said to someone a year ago, interest rates will be cut by 225 basis points in the next year, most people would have said, brilliant, that's really going to get things cooking. Why aren't we cooking now?
I think it just shows you, maybe how overcooked things were in the first place. But also, I guess, even though we're coming out of the worst of it, there is those headwinds still really hitting households and businesses quite hard, whether that's the global picture, the labour market. And as we've sort of already pointed out, things are looking better ahead, but the reality right now is that it still hurts. If you're looking at, for example, we know first home buyers have been a bit more active during this period, but investors haven't. Investors are still looking to rebuild equity in their portfolios.
The other interesting driver of the economy is the export sector and the external position, and the currency. Because the one really bright spot we've seen in the economy in the last 6 to 12 months is export receipts, particularly from meat and dairy, where prices are at record highs, where climate change around the world is restricting supplies. There's plenty of demand from people who love burgers and butter. What are we seeing coming out of the rural sector, provincial New Zealand, from those record high prices at the same time as, for most of that period, the New Zealand dollar has been relatively low and hasn't raced up with those prices, which is a double whammy benefit for the sector. How is that playing into the rest of the economy?
Well, I think the rural sector has really, driven most of the growth that we've seen so far. And we know that we're seeing job creation in that sector where other sectors are still probably downsizing or not really hiring. We have seen that, job creation there has taken off a bit and been the main benefiter there. In terms of the Kiwi dollar, the Kiwi dollar, it's been a really interesting one. We've recently sort of updated our forecast for the Kiwi dollar, and we were looking at how our forecast a quarter ago played out. And basically what we found is that our forecast for the Kiwi dollar played out for a whole year, played out in one quarter. We started the year at about 50, 57, got down to about 55, I think even a low of 54. And then before you know it, we were at 60 cents, which is where we said we would end the year. Now we've refreshed our forecast. We're still saying, today the Kiwi's around 60-ish cents. We think might end the year there. But there's a really interesting story playing out of the Kiwi dollar. We have to look at it in a relative sense, right? With Kiwi against the US dollar. And,
That's right, because it's not always about us. When there's the breakup, we always say, oh, it's not you, it's me. But for the New Zealand dollar, it really isn't always about us. It's sometimes about what's happening with the US dollar.
Yeah, because right now what we're seeing with all this uncertainty, global pressures happening in the world, there has been a bit of a questioning of the US dollar as a safe haven asset. Some have even gone as far to say whether it's still the global reserve currency. I think that's a step too far. But there's a bit of a questioning of, is it the safest asset to be holding? So we've seen a bit of a diversification away from US dollars, which, has put a bit of upwards pressure on the Kiwi dollar. I think we put it really nicely in our report that we wrote recently, which was if we had spent the last couple of months deep in the Himalayan mountains, we would be oblivious to what has happened in the Kiwi dollar. But if you told us the headlines of everything that's come out, we would have told you that the Kiwi dollar would actually be lower in the low 50s. But of course, because of the sort of move away from US dollars, we've seen the Kiwi a bit higher.
Yeah, that issue of will the US dollar retain its role as the reserve currency, king dollar, as the safe haven when things go pear-shaped, people run to put their money into US treasuries and US dollars because they think, this is the world's largest economy, it's the most powerful military, it's when it all goes pear-shaped, you want to make sure you're in US dollars. That's the thing you're taught when you're a junior economist or trader. When it's all going to hell in a handcart, just buy some US dollars. But what has gone on in the last 6 months or so to shake people's, belief in that sort of fundamental thing?
Yeah, I mean, it's just with, I guess, everything that's gone on with tariffs and trade policy and, is it really the safest bet? But I think there's still not a good enough argument that it's not, right? I think the question we always ask is, okay, where are you going to go, right? Are you going to go to the euro? That's not the most stable either. Sometimes the Swiss francs and the Japanese yen get a little bit, but again, is it really the reserve currency?
And you don't get much for your money there. They've just cut their interest rates to zero again.
Exactly. So it's definitely a very interesting one. At the same time, you have seen a move to gold, for example, not quite a currency, but we've seen gold, heading higher and higher. So at the end of the day, though, I think it's a conversation that will come up more over time, but not necessarily happening in our lifetime just yet.
So we've got an interesting week ahead. I suspect, like me and a few others, you'll be glued to your screens at 2:00 on Wednesday afternoon to see will they or won't they cut. And we'll see how Christian Hawkesby and his monetary policy team decide to either tie-ho or cut again. Thank you very much to Sabrina Delgado from Kiwibank for being on When the Facts Change. Ngā mihi nui.